Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Can history teach us about the market's next move? Well, our market timer, Kevin Cook, may be able to shed a little bit of light on that. He joins me now. So they say that in the markets, history may not always repeat, but it oftentimes rhymes, right?
Very true, yes. And that's why we look at charts. We look for the patterns to say, oh, this pattern has happened so many times in the past. Yeah. Looks like it could be unfolding now. That's what we try and do with charts. What I want to do today is just focus on past rallies that this rally could become like. Everybody's trying to call this rally overbought, so let's look at some past parabolic rallies.
Okay.
This is the from the 2010 bottom in the summer, from August until into May of the following year. So that should actually be May of 2011. I have August to May. So the rally was 330 S&P points from 1040 to 1370 in 8 months, with the largest pullback being only 6.7%. That's quite a run. Quite a run. So that's one we want to pay attention to.
Okay.
Now let's go back a couple of years. From July 2006 to July 2007, about a year, the S&P rallied an identical 330 points from 1225 to 1555 in 1 year, with the largest pullback being only 6.8% again. So, here are a couple of parabolic rallies. We're not even close to this in terms of the magnitude right now, and that's one reason that I think this rally can keep going.
Okay, so the rally's got further to go, but can you tell from this point how much further and when it might be time to sell?
This is obviously the $1 million question,
right.
And I would say that this rally, with the steam that it's building, has legs to make new highs. And my target this year is 1,600. Most street houses, Wall Street houses, are not much above 1,600. I think Citi's at the top with 1,625. And the consensus is actually like 1,535 among Wall Street houses, because you've got Morgan Stanley and UBS calling for lower levels from here. They're calling for going back to 1,300.
Okay.
So that's why the consensus kind of washes out here around 1,535. So I tend to be on the upper scale of optimism. But, what I say is everybody wants to call the top now. They think the market's overbought, and they think, it's going up like this, parabolic. Now it's going to come straight down. Well, that's not the way these things work. With all this buying pressure and all the fundamentals that money managers believe are good, that's going to keep them buying, and that's why we don't get much of a pullback here. So it brings us to the question, what will the top look like? And until we see a top forming, we don't need to worry about selling. So let's look at some past tops.
Okay.
This is the year 2000 top. And now these are weekly charts. Look how, so those are, each one of those price bars is a week. So look at from December 98 until early 2001, how many weeks, how long that took to form that top above 1,500 on the S&P in the year 2000. Note I've drawn a yellow line around 15, 25, 30. That's been an important level that we just got through now, 13 years later.
Okay.
All right. Next top we want to look at is the 07 top. Again, a weekly chart. So each one of those bars represents a week. You have a long, drawn-out process of a year and a half here with the S&P, flipping back and forth between 1,400 and 1,550. Just another long out drawn topping process. A lot of up and down action, and you may get that head and shoulders pattern where it goes up, comes back down, new high, and then a lower high over here. Classic head and shoulders pattern. These tops take 6 to 12 months to form. Let's look at a more recent top that wasn't quite as long. I say that tops look like M&Ms, because they go like this. The 2011 top was only a 7-month process. And we traded between 1260 and 1360. I think our next top will at least have to look like this. So we're a ways from a top here because we haven't even seen a topping process, and there's still pent-up buying demand from equity fund managers. So until we see something that even looks like the 2011 top, I think that will have many tradable rallies in those M&Ms, so to speak. We're not even close. So this rally, we can go to 1550 this quarter, maybe back down to 1,500, and then on to new highs. So these things won't look like a V, that's for sure.
So TAP can take 6 to 12 months to form, really. That's interesting.
Yeah.
Last couple of times, speaking of interesting, that we talked here, you mentioned one veteran prognosticator who called for a 5 to 8% correction after the President's State of the Union address.
Yeah, Jeff Sott of Raymond James.
What's up with him now?
So he's another guy. He's been around. He's been in the markets 42 years. He says he's been keeping stats since the 1960s. So I've shown you some history here. Now let's crunch some numbers with him. So Sott looks at these buying stampedes, and this is what he was talking about 3 to 4 weeks ago. He wasn't directly addressing that the President's State of the Union would be the pivot point, like oh no, the President has said this, now we're going lower. He saw that as a time cycle period where we'd be coming to an end. He talks about buying stampedes lasting 17 to 22 days. Here are some stats he's citing in an article he wrote yesterday. This rally has gone 501 calendar days, now 502, without a 10% correction. That's debatable because the drop last April into June was, depending on what high-low you use, it was just over 10%. But obviously he's using closes that would make it like a 9.5% correction. October 1990 to 1997 saw over 2,500 calendar days without a 10% correction. Just a slow, steady rise there. I find that one hard to believe too, but it was worth 233% in the market. Then Jeff Sott looks at day counts. I mentioned buying stampedes, what he calls them, lasting 17 to 25 days on average, and he's looked at hundreds of them for the past 4 or 5 decades. He finds one of the longest ones ever was August to October of 06, was 53 days long, and a buying stampede is when you only get like a 1 to 3 day pullback, and it's very shallow. And that's what we're seeing right now. August to the top in 1987 in August, that was a run up of 38 days in a buying stampede. We're in day 35 of this buying stampede. Wow. So that's what he's paying attention to. One last thing I want to mention, we did the roundtable yesterday, me and Shiraz is still drilling down on the bear case. The fundamentals are terrible. They don't justify this rally. It's all driven by Fed liquidity.
Right.
Another gentleman in Shiraz's camp is Doug Cass, fund manager for Seabreeze Partners.
Yep.
And he wrote a piece yesterday, a lengthy piece, which sounded like I was reading Shiraz. When you look at the bearish fundamentals around the world, these are the things that they're focused on, that the fundamentals do not justify this rally, and it's all driven by Fed liquidity. But as long as price keeps moving, I'm staying with it and looking to buy a pullback, as I think a lot of money managers still are. Okay,
Kevin Cook, our market timer, trying to help us understand this market rally from a technical perspective. Read other articles that Kevin submits to the folks at Zacks.com. If you're not there already watching this video, he puts them there for your reading and for your consideration. He has some interesting perspectives on a lot of different things. Just go to Zacks.com's homepage. You'll be able to see them right there that you can link to from that point. With Kevin, I'm Terry Ruffalo.